Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, how are you? We're back again.
Andrew, always back again, and I am good, my man. I am good.
Very nice. So what are we jumping on the podcast to talk about today?
Yeah, so this is an interesting one just because of what's happening, I guess, with interest rates in particular. And, you know, we're obviously have been talking a little bit about the cost of servicing a mortgage, but now's a good time, and this is why we've pivoted into this particular topic, but talking about getting into your first property. So for those that are listening to everything that's going on, hopefully it's a bit of information, a little bit of guidance in terms of what to think about and what to consider, just to try and maybe cut through some of the negativity that we tend to be exposed to with increasing interest rates.
Yeah, exactly. So, you know, what we're talking about today is almost a checklist for first home buyers. So really, you know, a few bullet points on things you need to do, things you need to consider when you're jumping into your first property. And we do say first home buyers, but really this is a checklist for anyone.
Yep.
I mean, yeah, a lot of people maybe bought property a long time ago or weren't really sure about what they were doing or why they were doing it the first time that they bought property. But really for anyone that's purchasing property and just needs a bit of guidance on things that you need to consider.
Yeah. Andrew, where do we start?
First one has to be do your research. That really has to be the first one. Sometimes people think that, hey, you know, I'm either employing a buyer's advocate or I'm, you know, purchasing a property to live in, so investment doesn't matter, but just do your research. Make sure that you know the area. Make sure that you've looked at comparable properties. Make sure that you've been to auctions and actually seen, you know, how much competition there is out there for the type of property that you're looking for. So just do your research, be informed, and, you know what something is going to cost, because it doesn't matter whether you're, you know, you might want to live in a particular area or you might want a particular type of property, and you're either relying on old information or just gut feel, and you go through this entire process of, you know, engaging with a mortgage broker and getting financing, and then you go out there and you realize that, crap, I can't actually afford what I'm looking for and I'm going to save up for another 6 months, and you've just utilized a whole bunch of your time that probably could have been better spent elsewhere.
Well, that kind of leads into our next stop point, but just on that, in terms of doing your research as well, one of the things that I think that we get exposed to a fair bit is knowing the process of actually what happens. Like, you know, you go and look at a place, fantastic, you get excited. Okay, then what? Right? So knowing the steps and knowing how it all transpires in terms of, you know, needing to get the contract looked at by a conveyancer, potentially doing a property and a pest inspection, to needing a deposit on the day. How much is that? How long settlement? What does that look like? All of those things.
You just basically rattled off the whole podcast.
Well, no, it's definitely nowhere near that. But as part of your research, not only just the specific property itself, but also the process associated with it, especially if you haven't had a lot of experience in purchasing as well, because it's easy to make a mistake. And if you do make a mistake, it's usually quite costly as well.
Yeah, exactly right.
But in terms of, I guess, one of the other things on that checklist box, don't waste your time going and looking at properties until you know what you can borrow.
Yeah. Get a pre-approval, please. I mean, look, it's for everyone's sake, for your own sake. You don't want to get emotionally invested in a property and realize that the bank's just not going to lend you that much money. You definitely don't want to be bidding on a property if you don't have a pre-approval in place and you know that you can get finance. Make sure, and especially in this environment, make sure that your pre-approval is still valid.
Yeah.
Most pre-approvals generally last about 3 months.
Yep.
With an increasing interest rate environment, just because you serviced and just because a bank was happy to lend you a certain amount of money 3 months ago or 6 months ago does not mean that that's the case today. And that's in any market, but especially in this market, make sure that your pre-approval is valid and make sure that you know you can actually afford what you're bidding on.
Yeah, and can't stress that enough. The other thing is as well too is not only getting your pre-approval. I mean, that's a great place because it'll tell you, I guess, two other things in terms of where you should put your deposit, as in should you try and save up for a 20% deposit to avoid mortgage insurance, or should you consider something less so you can get into the property earlier and faster and potentially pay mortgage insurance and what that will cost and what it will mean in terms of additional repayments. But the other thing too is if you're paying stamp duty, that is what's the stamp duty cost going to be on top of that?
Yeah.
So you really need to make sure that you know your numbers from a pre-approval perspective, not only in terms of your deposit and what that looks like, your stamp duty, and then even further down the line is from a serviceability perspective. Okay, if I can buy for this and I have to pay that out as a deposit and stamp duty, what are my repayments going to be? How much am I actually borrowing?
Yeah.
And what's that going to be month in, month out, assuming that interest rates remain steady or whatever the rate is today? Knowing that number and knowing those numbers is absolutely critical because, you need to do that even before you start even looking at property.
Yeah, absolutely. Absolutely. And look, it touches on probably a couple of points there. One is, discuss and look at whether you're needing a 10% deposit or whether you should be waiting to save up to a 20% deposit. Have a look at whether stamp duty is applicable. So depending on what state you're in and what the level of the property is, if it's a first home and you're living in it, there may not be any stamp duty. But if there is, know that you're also going to need money for stamp duty on top of the deposit. Can't tell you how many times someone's looking for a property at 800,000, they've got 160 grand stamped up, and you're having the conversation and look, do you wait? Do you, pay mortgage insurance? And like, what do you mean? I got a 20% deposit. And it's like, no. Stamp duty is on top of the deposit as well as, or you need to pay stamp duty on top of the deposit as well for that full 20%. And in addition to that, banks will run what's called serviceability. So when they assess whether you can afford a loan or not, a bank will run, okay, firstly, do you meet the deposit criteria? Tick. Let's say you meet that. Secondly, can you actually afford this mortgage based off what your expenses are, based off what your level of income is, what the mortgage is going to be and the repayments thereafter? Mm-hmm. So banks will assess that when they decide whether they will or won't offer you a loan. So that's what's called serviceability, and that's all part of the process of applying for a pre-approval. Just because a bank will lend you a certain amount of money does not mean that you need to borrow to that maximum amount or purchase to that maximum amount, nor does it mean that you should. So you do need to look at your own affordability. You really need to look at, when this property comes in, when I've got, mortgage repayments, and not just mortgage repayments, but, repairs and maintenance, potential body corporate fees, any renovations that you need to do on the property. Is this actually going to be affordable? And am I sacrificing too much from a lifestyle perspective? Can I, realistically do this? Is a really important step before you sort of start going down that route.
Furnishing the property as well too.
Yeah.
So it's plus. But yeah, you definitely hit the nail on the head. And that's really prudent at this point in time as well too, because interest rates have increased, at the fastest pace that we've seen in history. But for a very, very long time, you kind of didn't even need to worry about what the interest rate was and how much you were borrowing because it was so cheap to borrow money.
Yeah.
Whereas now it's, an incredibly different environment than what it was, 12 months ago. People are needing to pay and are needing to pay a lot more attention to the amount of debt that they've got, because when interest rates move and you've got a bit of debt, it definitely bites.
Yeah.
So just because you can borrow that money on paper in the eyes of the bank, you need to be comfortable with your position as well too. And don't forget, there's mechanisms around it in terms of refinancing, resetting the loan term. But on paper, you're borrowing that money and you're making those repayments month in, month out, over a 30-year term.
Yeah, exactly right. So make sure that you're not only factoring in, the repayments now, but what are the repayments with, an interest rate buffer that's in there if rates continue to rise even further than what they are.
Yep.
Another consideration when you're, talking about financing, when you're talking about debt, principal and interest only. Thoughts, Billy? And I'm leading you down this garden path because I know where you're going and I want you to go there. But yes, thoughts on that in that regard? So
my own personal preference and bias here is I don't believe that you should be borrowing money that you're not paying the principal back.
Yeah.
Obviously, in terms of what we do for a living, I understand when there's deductible debt, making an interest-only repayment, so you can put the principal that you would have paid on that deductible debt, maybe you put that on something else like your non-deductible debt, your home loan, your principal place of residence home loan. But my own personal opinion is if you're considering interest only because the investment or the cash flow only stacks up because you're interest only, I definitely think that's the wrong way to go.
Yeah, exactly. So you want to play that game potentially if you're doing it from a tax minimization side of things. There's a broader strategy with it. But really being careful with interest-only repayments, especially as a first home buyer. And moving into, currently in an interest rate environment, which is significantly higher than what it was in the past. If you're doing that because you can't afford principal and interest repayments, there's some serious consideration as to whether you should be purchasing that property or not, or taking on that level of debt.
Well, it's actually in the wording that you just said. If you need to put it on interest only to make it stack up, you're borrowing too much money and you can't afford it.
Yeah.
Period.
Yeah, exactly right.
Andrew, fixed versus variable?
Yeah, I mean, look, if you were on a fixed rate previously, you definitely were a good winner if you managed to lock things in for, the 2% interest rates of what we were seeing in the past. But basically a fixed rate is fixed for a certain period of time. So no loan is fixed for 30 years, unfortunately. It's not like America or most of the home loans in America. But in Australia, generally, you're looking at a fixed term of 1, 2, sometimes 3 years. I've seen further than that, but most people are, fixing the loan. Some of the considerations with that is, one, what your expectation is on interest rates. Obviously, if you expect interest rates to go up, then maybe you consider a fixed rate loan. If you expect interest rates to go down, then you'd probably want to be on a variable loan. So there's that aspect of it. There's no right or wrong because either way you are sort of taking a gamble. But the other consideration is if you are looking at a fixed loan, you're not able to offset the mortgage. So if you are going to be saving money above and beyond your normal repayments, you're not able to put money into an offset account, which will offset the amount of interest that you're paying. And so some consideration to that is having a hedge of both. So having a portion that's fixed, a portion that's variable, all comes down to individual preference, all comes down to expectation around savings and cash flow, as well as the expectations around the interest rate environment as well.
Yeah, and I think from my end, I mean, I look back at my journey in terms of mortgages and things, but really the fixed part of the conversation, and unless you're fortunate where you can arbitrage it and take advantage of it, like as an example, if you take a fixed rate now, you're paying a significant amount. So whether you'd want to lock that in thinking that we may be getting to the top of the interest rate cycle, you want to fix it at that, probably not. And I wouldn't necessarily be thinking about it as an arbitrage opportunity saying, hey, I can beat the variable rate market because you need to be lucky. The way that I'd be looking at this, and it's probably a greater consideration if you're new to having a mortgage, is that the certainty that a fixed rate gives you over the variable rate. Because for that period of time, let's say you get a 2-year fixed loan, for 2 years, rain, hail, shine, your repayments are going to be the same each and every month for 2 years. Whereas if it's variable and you're just getting used to servicing debt because it's a new mortgage and, the associated costs of owning a house and things come from left and right, then maybe you want that certainty to basically help you, I guess, meet the sleep test that we continue to talk about, that you can go to sleep and rest your head at night knowing that regardless of what happens in the external environment, your rates are going to be the same. The flip side of that is also true too, that if rates start to go down, then you're on paper disadvantaged, but that peace of mind and that comfort knowing that those repayments aren't going to change, I think at least if you're doing it for the first time, is definitely worth a consideration.
Yeah, absolutely. And that peace of mind sometimes is just what people need to know that, yep, I'm comfortable. I know that I can meet those repayments, and whatever happens, I know that everything's going to be perfectly fine. Also, as well, within that is, you're taking on a larger mortgage than what you've been used to. So you're looking at, second property, potentially third property, and saying, all right, previously I had a loan of 500 grand. I'm now bumping that up to 1.5. Just as an example, I want to know, with everything that's been happening, at least I know that, my mortgage costs are going to be fixed. I know it's affordable. So it gives me, a couple of years of knowing exactly what those repayments are going to be as well.
Spot on. Price limit when you're bidding.
Can't stress this enough. Set a price limit. Set a price limit, stick to it. And look, I know that this is probably, not the advice that potentially a buyer's advocate would be giving or anything like that. But
or maybe a real estate agent.
Yeah, or maybe a real estate agent would be giving, but stick to it to the dollar. I mean, it gets very tempting to say, oh, bidding slowed down, let's just put in another 1,000, another 5 grand. And
close. Yeah. We're so close.
And that just continues to snowball. Like, you put in $1,000 bid, someone else puts in a 5, you put in another 1, and all of a sudden you're 10 grand over your limit. And where does that money come from? So set a limit, stick to it. I personally, one of the things I like, and whether this is, whether this is actually true or not, but I like to set a limit on a property that's not necessarily a round number. So let's say you're bidding up to 700,000. You might say, you're going to bid to 706,000, because most people will set their limit to 700,000. So you're giving yourself you're already factoring in those extra little bit of bids. Whether that works or not, I have absolutely no idea, but it helps me sleep at night.
My OCD is going berserk, right? So just... No, but absolutely, that's a really sound strategy as well too. Because the truth is, real estate agents, auctioneers, an auction is designed to try and maximise the result for the vendor. Yeah. So it's a high pressure environment. It's highly emotive. It's designed to get more money out of your pocket. So being able to keep your cool, setting a predetermined limit and sticking to it, absolutely critical. That you don't buy something that you're going to regret the amount that you paid for it down the track, or even worse, you realise that you can't afford it.
Yeah. And auctions, you can't back away from an auction.
Yep.
Once you make a bid in an auction, it is binding. Same story, I think it's 3 days before an auction?
3 before, 3 after.
Yeah. 3 days before an auction, 3 days after. It is also binding. It's under auction conditions, even if you aren't necessarily bidding at an actual auction. So whatever price you're offering is a binding offer.
Yep. A good strategy as well too that we're encouraging people to do, because it's such a big decision and it's such an easy one to get wrong, is using a professional, talking to a buyer's advocate.
Yeah, absolutely. Having a professional on your team, one, just in the bidding process, but also their expertise around the type of property you should be looking for, around growth areas, and even for, investment properties, expanding it beyond just, the area that you're comfortable or have knowledge in. Expanding beyond that is, another tool that you can have in your arsenal. So considering a buyer's agent or a buyer's advocate is, another thing that we're strong advocates for as well.
And I guess we're seeing more and more of that become a reality. Generally speaking, it's a fairly new profession. So that's becoming more and more common and more mainstream now, which is great. But yeah, having someone on your side, in your corner, not only for all of those positive levers that you were talking about before, but preventing you from making a mistake, which is probably the biggest thing that you want to achieve, as opposed to the opposite, saying, hey, I want to buy something that's going to grow as whatever it may be. But avoiding the mistakes is probably the main value driver in my mind, by getting some assistance in that regard. Absolutely. This one's a no-brainer, right? Fairly cost effective. In comparison to the price that you're paying for the asset, for the property, spending that money on a building and a pest inspection, I don't know what they charge these days, but it's pittance in comparison to the property itself. And why wouldn't you get a deeper dive into the condition of the property that the layperson can't see because we're not skilled or qualified to? Get that information, and at least that way you know that you can buy with confidence knowing that there's no issues with that property, or if there is, you can then make an informed decision how much it's going to take to remedy that, or if you're not comfortable with it, you can walk away.
Yeah.
But absolutely no brainer.
Yeah, definitely.
Conveyancer, lawyer?
Yeah, look, another big thing is getting a contract of sale, 30, 40, 50-page document, a whole bunch of things in there. So a conveyancer and a lawyer will firstly not only help you with settlement, so when you're actually settling on the purchase and that property is being converted over to your name and liaising with the banks, they'll handle that process for you. But in addition to that, what they will also do is review those contracts. So get an agreement with a lawyer or a conveyancer, tell them that you're looking to purchase. A lot of conveyancers or lawyers that can also do this will incorporate in there either a per contract that they're reviewing fee, or some of them will bundle it up and say, we'll review up to X amount of contracts before we start charging you per contract. So getting them to also look over the contracts, which will also highlight potentially some of the building and pest issues, or even body corporate issues or anything like that that are also involved in the property. I guess some of the major differences, so between like a conveyancer and a lawyer, is if something happens post-settlement, and a lawyer will be able to assist you. A lawyer will be able to come in. So if something goes wrong thereafter, you do have that peace of mind that a lawyer is there to help, whereas a conveyancer will generally only help in that initial part of facilitating the transaction. Anything that goes wrong after is, up to you to find another lawyer. So our recommendation is generally just to go to a lawyer off the bat, just because you do have someone that's there and able to assist you thereafter.
Money well spent.
Yeah, absolutely.
Yeah. And then probably the last thing as well too, and this is always a little bit more challenging because it's a different take and it's not necessarily related to the transaction itself. But if you're going down that path where you're taking on debt, you're going to need to be servicing this debt for a long period of time, is looking at your personal insurances and getting them reviewed.
Yeah.
Making sure that in the event that something happens to you, you can still afford to make the repayments through something like income protection, or if it's something a bit more severe where you're getting larger lump sum payments, that then gets extremely critical when there's other people involved. Maybe you've got a spouse, maybe you've got children, but at the very least, get your insurance reviewed and just view it as another checklist item that needs to get looked at and reviewed and done, and be prudent and do it. Pretty straightforward.
Absolutely. You're engaging in some, or, for a lot of people,
the
more
biggest
than you ever will have in your entire life. So making sure that there's something there to protect you if something goes wrong, hugely important.
Just by chuck out an analogy, and I find this one really interesting, but people go and buy a vehicle, and regardless of what you spend, you can spend a small amount, you can spend a big amount, but they go and buy a vehicle, and one of the first things that people consider is I need to get a cover note.
Yeah.
And then I can sort out my insurance, or I need to get my insurance in place. So that's a natural part of the process, which is critically important as well. But that same thinking doesn't necessarily translate across to property purchase.
Yeah.
I find that really interesting because for the majority of people, purchasing a property will be the greatest purchase or the largest purchase that you ever make.
Absolutely. Maybe we need to start petitioning the government to, enforce it as mandatory. I mean, look, I'd certainly be, on that bandwagon, because you consider that it is illegal to drive a car in Victoria without having at least third-party insurance on that car. I think that having a mortgage without having an element of insurance cover is far more detrimental to that person in terms of the potential outcomes of that. So I definitely think that if you do have a mortgage, whether you've had one for a number of years or you're embarking on a new mortgage, making sure that you've got some personal insurances is so important.
I think this can pivot into a conversation around responsible lending, right?
Yeah.
So maybe the lender, the person providing the mortgage, the funding, needs to consider that. I don't know. Maybe Maybe we start petitioning government, Andrew. I'm not sure. So
we started off on a podcast, and look at what rabbit hole we've gone down.
Turning into politics. Andrew, well said, well summarised. Hopefully that gives our viewers and our listeners an idea of the things to think about when they're purchasing property, and specifically if you're new, a first home buyer. We didn't talk about any of the particular grants or anything like that may be available, but that's also the case as well. But we wanted to be a little bit more general in terms of the things that you should be thinking about and considering when you're looking at purchasing a property.
Yeah, absolutely. Bills, thanks again for jumping onto another podcast. Always great to spend some time having a bit of a chat around, some issues that I think, really helpful to spread that knowledge around. To our listeners, thank you very much for jumping on, and like and subscribe. We look forward to catching you on the next one.
Cheers.
Thanks for listening today. If you have any questions on what we've talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.